Alpha traders and TradingView. We have our first educational video live here. We're going to talk about the introduction to VEPS. What is the definition of VEPS? The acronym VEPS was first known to be established by the co-founders of Alpha Trading to explain their method of trading using indicators, which are effectively calculators built on the things that make up those components. Apart from the volatility, entropy, probability, and statistics, those compartments include the mean, the returns, aka the log returns on investment, randomness, geometric Brownian motion, aka GBM, normal distribution, Laplace distribution, correlation of price action, correlation of historical price percentage, and more. And part of the history of VEPS is the Black-Scholes model. Take it away, Yasha.
Yeah, hey everybody. VEPS is basically an evolution on the concept of trading volatility, which was established by Mr. Fisher Black and Mr. Myron Scholes, who were two economists who in the 70s established math-based formulas. And one of the formulas they established is known as the Black-Scholes equation. And the whole point of that was to be able to trade options using mathematical methods like standard deviation models for distribution, and how they parlayed that into long-term capital management, which is a company founded by John Merriweather, and then how effectively their arrogance, which is what got in their way because they were so sure that it couldn't fail, and the stuff that they didn't know about randomness, even though they knew about randomness, they didn't understand every concept about it, and the lessons that they ignored about things like the 1987 stock market crash and things that they didn't know about entropy effectively killed their company in the 1990s when things started to fall apart from them. And it almost collapsed the entire U.S. economy until the Fed bailed them out because the market was basically all in on their way of trading. And effectively, what we now have is a better, more evolved way to trade with better tools now that we can take into account certain things that they just did not know. In any case, they are considered, Mr. Black and Mr. Scholes are considered the founding fathers of the concept of trading volatility. And excuse me, and this way of trading was popularized by it on the options market. The entire options market, before they brought this to light, essentially snubbed their nose at trading quantitatively or using any kind of mathematical means, and they were laughing at them until they weren't. And together with Mr. Robert Merton, Black and Scholes and Merton received the Nobel Prize in economics for their discoveries. And effectively what we have now is all of the high-frequency trading firms and all of the top algo shops use mathematical formulas whose roots are steeped in Black-Scholes equation. And that's the basis for trading VEPS.
Very, very good explanation of the Black-Scholes model for anybody. For anybody, that's a lot to take in, including me. And I've been studying this for quite some time. Yasha, he's our Alpha Trading AI. He is Cliff Clavin. Let's see here. Right, 100%. And so, and that is very important when it comes to VEPS trading. You need to understand that. Right. And also, what else? Basic concepts of probability and statistics. Right. The basic concept of probability and statistics. What are they? What do they do? Right. You've got normal distribution. That's the standard deviation distribution, and Laplace distribution models give you highly accurate probabilities for trading in key target areas for entries and take profit areas, as well as areas to limit loss. And we talk about this all the time. Everything that you see on our live streams, this is all based on probability and statistics, right? Great areas to take profit. This is, and I want to talk about this because a lot of people, they want to try to front run this. Now, when you're looking for entries, a lot of people, the way they trade gaps is wrong, right? People like to trade to a gap. When you don't trade two gaps, you trade when data sets get two gaps. That's when you trade gaps. Same thing with probability levels. You're not trading to a certain level. You're waiting till a data set gets to a probability level where the probability percentage of that data set reversing is very high, right? And so you can get entries using distribution levels. Most of the time, though, they are used to take profit. It's a no-brainer. As an alpha trader, we know this. We've been teaching this for years now. And so that's what you need to understand. And when I'm talking about distribution levels, let's go over onto our chart. I'm going to give, let's see, let's pop up one little screen here. It's going to be on the dollar index. You know what? Let's just go to Bitcoin. We'll go to Bitcoin. We know what the dollar's up to. Let's see what Bitcoin's up to. Okay, so when we talk about different distribution levels, I'm actually going to turn off the VRE as well. I'm going to populate normal and Laplace distribution levels all. Okay, we're talking daily and 4-hour levels. The daily levels are the white and blue cross lines. The 4-hour are the white and blue solid lines, the skinny little lines you're seeing here. Now, what does it mean when you're trading this distribution, right? Again, it's all about probabilities and what happens when data sets get to these probable levels. You can see all these white cross lines. These are daily levels. The blue cross lines are daily levels. Can you see what we're talking about? All these levels get hit, right? All these levels are probabilities, okay? And so what is the liquidity that's moving these markets? The high frequency trading firms. Do you think they know about the distribution? Do you see all these areas getting hit? Even down to the 4-hour levels, it's always the distribution. No matter 4-hour, daily, like right now on Bitcoin's data set, right? We get this dump out this morning. We started closing 15-minute candles below the bottom side of the 68.3 Laplace distribution range on this daily. As soon as that happens, here comes the dump. You see, this was a 4-hour candle. You get a little fake out to the top side. Where does it end up? Right at the first standard deviation on the 4-hour, right before that 4-hour candle close, comes back up to the bottom side of the 4-hour 68.3 Laplace and dumps from there. Where does it dump to? Second standard deviation normal distribution, 95.4% Laplace distribution ranges. Now you need to understand the bell curve of normal distribution. That's normal distribution, right? There are standard deviation levels. When we're talking about Laplace distribution, there are no standard deviations. There is just merely probability levels. Both of these are 95.4% levels. And you can see what happens. Now, why hasn't the data set, these are daily levels too, on a 15-minute chart, right? So you can see right here, when I'm talking about probability levels, there's a 95.4% chance that this daily candle on Bitcoin does not trade below this level by the daily close. We're talking about 29,170. Let's just go 29,200 area. It's been, look at the wicks, sending wicks down through here. There's still a 4.6% chance you can make it to these lower levels. And so what's next? We got a third standard deviation level. Are you going to move for me, chart? Come on. Interesting. Let me scale this down a little bit. Now it should move. Okay, there it goes. Trading view. We're lagging. Let's go. There's the third standard deviation level down here, right? So if you see this data set during the day drop below a 95.4% level or second standard deviation normal distribution, I'm immediately looking for the 3SD, right? We're talking 28,566. Now, we did a stream this morning explaining exactly where the probabilities are pointing this to go. As a daily level right now, though, we're kicking up, right? There's only a 4.6% chance it closes below here. So what are you going to do? What probability are you going to go with? If you're trading on probabilities, there's a no-brainer. Are you shorting this down here? No, absolutely not. We're already at a daily 95.4% level. Just because I would not short this doesn't mean it can't go lower. It can. But as a short here, I'm already out of my trade in profit. Go ahead, Yasha. What do you want to add?
I just wanted to add that on top of what you're seeing here, the entire reason that we look at these levels that Bilbo has been talking about is because these distribution levels and this method of trading, the volatility, entropy, the probability, and statistics, basically, even though it was developed for trading options, is something that we figured out how to trade, basically scalping delta with the VEPs. And doing that lets us trade really low time frame volatility, entropy, probability, and statistics, and get in and get out of trades really quickly, as opposed to longer term options trades. So we have the option to do both short term fast trades and longer term options trades with this method of trading, which is really handy, really convenient, and it doesn't matter what time frame you're on. These mathematical targets work on any time frame, and this distribution model and system for trading works on any time frame. And then on that end as well, because we're dealing with volatility and with entropy, there happen to be 6 tendencies of trading volatility that's correlated to price action, and entropy correlated to A2.EPP, which is alpha squared and entropy price percentile, or also the Shannon entropy percentile. And either of those ways of correlating the entropy will also give you the same results with the tendencies that we see on volatility. If you don't know what I'm talking about, you should refer to the tendency cheat sheet, which is available to you in your handy reference book and the Alpha Trading Discord. I just wanted to mention all that.
It's beautiful. Beautiful, beautiful, beautiful. And yeah, and that's how Alpha Trading has put all this together. It's all probability and statistics. It's a no-brainer. We realized a long time ago when we were trading traditional TA, we were using lagging indicators, right? And we started seeing these volatile moves that if we're talking about, the markets in general, nobody has seen anything like cryptocurrency before. It's very volatile. But what has happened? I have noticed over these last few years, right, that the algos, these high frequency trading firms, where people do not think these institutional people are trading crypto, look, they follow the volatility. And that's what we're getting ready to go into. They follow the volatility. They don't care if it's in Bitcoin or SPY or commodities, right? They just don't care. Is it in a Forex pair? They're going to go where the volatility is. And these days, they got their hands full. These markets are full of volatility these days, which makes sense, right? The current economic conditions dictate that, in my opinion. You're going to see some wild swings. So when I'm saying you're going to see more wild swings, what's more important these days? The distribution, right? Because the market is random. The market's random most of the time. So how are you going to know where to take profit at on these big volatile moves? The distribution. It just showed the big dump that we had on Bitcoin right down to the 95.4% Laplace distribution range, second standard deviation normal distribution, right? Target hit, profit taken. If you did not take your profit down here, you already lost almost 3/4 of your profit. Okay. This is what we try to explain. And then the volatility itself is going to be very important. There are 6 different tendencies when it comes to reading volatility. They go as follows. Okay. First, we're going to talk about all of the bullish tendencies. Okay. The first bullish tendency is when volatility expands and the correlation to the data set is positive. Okay. Now that's not what's happening right here, right? Not yet. It's trying to expand. Volatility. This is on a 1 minute too. I'm down here on a really low time frame just to get some action. So right now you can see how volatility was contracting, negatively correlated. We are waiting right now for an expansion in volatility. If it stays positively correlated, you're going to see this data set rise. That's the most important bullish tendency of this whole thing. Volatility expands, positively correlated, data set moves to the top side, usually in a rush. Volatility expansion brings what? Volatility to the data set. Okay, so the second bullish tendency is when you have contracting volatility negatively correlated. This is how data sets usually work, right? When you're moving into a pump, you're usually going to see volatility contracting, negatively correlated, price action starts to walk up, right? Price action starts to walk up. And as that correlation breaks to the downside during contraction, it usually ebb and flows into an expansion in volatility, positively correlated, right? So those are the 2 most important bullish tendencies. There's one more. It doesn't move a lot, but it definitely tells you what's happening. And that's when you get a data set that's flat. If the data set is just flat and it's negatively correlated, price action can walk up as well. It's all going to be with the correlation. And once you start studying this indicator, you'll realize that the most important part of when volatility expands and contracts, because that's all it does. Volatility expands, volatility contracts. It's the breaks in core perfect. And I will use that 5 look back all the way up to about a 4 hour. When I hit 4 hour, it's a good idea to switch it up to a 10, right? It's always a good idea to switch it up to a 10. And as you can see right now, as I'm getting ready to go into the bullish tendencies, right? You can see as this data set is dropping right here, what is happening with the low length volatility? It's expanding. The correlation broke back here. So you can see the little walk up we had to the top side of the 68.3 on this 1 minute candle. Look, the volatility contracted, negatively correlated. The volatility was like, well, we're going to expand now. Correlation stayed negative. So the data set is dropping. And as a 1 minute, right here, you've got the 95.4% level on the 1 minute time frame. So if I was scalping this move, where am I taking profit? Boom, right there, right? No ifs, ands, or buts about it. Now look, this thing can turn around. We're looking at a 1 minute. That's right. When you're scalping low time frame volatility, you better know what you're doing. And because what's going to be even more important is understanding a workflow, right? An intraday workflow for me, you're starting at a 4 hour, right? Now, when you get a new daily candle, I will look at that daily chart for just a split second. I want to see the volatility reads. I want to see if there's any outliers on the variance and on the entropy. What's entropy doing? Right. So then I'm going to move from there as soon as I get those reads, and I am dropping down through time frames, 90 minute, 45, 33, 15, 9 minute, to be able to get a bias from an intraday scalping, right? What is my bias? Is it to the top side or to the downside? Because trading low time volatility, not only do you need to know what's going on in the distribution, you need to understand risk. You have to understand risk, and that's what using a workflow is all about. All right. If my bias is to the top side, my risk on those scalps is on. I'm using 100% of my account. I'm never using leverage. Leverage is poison. We'll get into that into a later educational video, because if you really understood what was going on with leverage and the scam it is, you would not be using leverage. So anyway, so then we get back to this.
Yeah, let me just.
Yeah, go ahead.
No, I just wanted to say, because we're throwing a lot of information out there, it's an introductory course. That one of the tools that we won't really go over in this episode or this section of the course is the actual entropy tool, which is extremely powerful. That I'll just say this about it briefly. What it tells you is when there is a trending move or a random walk, which is effectively geometric Brownian motion. And that's all assets do. They either move in a trending move or in a random walk. And that tool is incredibly powerful. And just like volatility, it can tell you extremely directional, and can tell you when moves are going to the upside or the downside or sideways. And we will get into that later. But for now, this introductory course is really to go over the concept in a bigger picture and to go over these tendencies as Bill was doing with the volatility.
Yep. And that's pretty much almost, I mean, because the bearish tendencies are just going to be the flip side of the bullish tendencies. You look how this changed so quickly. What changed? Did the volatility change? Not at all. The volatility continued to expand. Obviously, now it's contracting. This is how this works. So you go into an expansion negatively correlated, but during the expansion, the correlation broke. So first you get the down move, the rejection off the 68.3 pretty much rode it down, right? But then the correlation broke. Volatility continued to expand. So the data set starts to move back to the top side. And this is how quick things happen down here on the 1 minute. That's why it's so important not only to understand what's going on with these volatility tendencies, but realizing where you are. Where is the data set? Where are the 4 hour probabilities? Because I'm looking at those. If I'm intraday trading and I'm scalping right here, am I waiting until we get back up to the bottom side of a daily 1SD? No, if I caught the bounce down here, probabilities dictated this was going to bounce. Okay. Where am I taking my profit? Am I waiting until the daily? No. We hit a 4 hour first standard deviation. There was the profit. Did the algos take profit there? You tell me. Of course they did. And where'd they run it to? Right back down. Right back down below, actually. But look, a wick got down below. the second standard deviation normal distribution, look where the 15-minute candle closed, above the 95.4 Laplace. But yeah, for the first introductory video about the VEPs, I think we've covered enough. I mean, this is a video everybody's going to want to watch. This is the starting spot, and we're going to be coming with a lot more of these for sure. Is there anything else you want to add, Yasha?
Yeah, you should probably watch this more than once, and maybe even on the slower speed.
Yeah, we talk fast.
Take notes all you want. Refer to the course manual. We'll be making that available as well to everybody in the Discord.
Big time.
And yeah, we will see you in the next episode of the VEPS trading course by Alpha Trading.
Yes, all you TV traders out there, you alpha traders, we appreciate your help. If you do watch this video, hit the rocket icon so we can get these educational videos out to as many traders as possible. And all that being said, we appreciate your support, and wherever you live at on this big, beautiful blue marble, have a wonderful rest of your morning, afternoon, and evening. Be looking out for more to come. Thank you.